And the dominoes keep falling. You have Snapchat down 41% today, at least while I was shooting this video, hitting as low as $13 after being at $83 just this last fall. Snapchat's IPO price back in 2017 was $17. So it has erased years of gains and gone back into the negative. Imagine buying the stock 5 years ago at IPO, holding through massive earth-shaking events that happened over that time period, seeing massive gains in the aftermath, and then at the end of the day, still losing money. That's what folks are seeing right now in sector after sector with stock after stock. But why did Snapchat today get the 2022 slapdown special? Well, they made public this note sent to employees and filed with the SEC. So that's who we issued guidance on April 21st, 2022. The macroeconomic environment has deteriorated further and faster than anticipated. As a result, we believe it is likely that we will report revenue and adjusted EBITDA below the low end of our Q2 2022 guidance range. Now, company after company is downgrading and anticipating huge headwinds for their businesses in the upcoming quarters. This isn't a new thing. But what's insane about Snapchat is they already went through this. They already went and downgraded their estimates and disappointed analysts quite a lot and saw their stock sell off. Analysts last month were saying, oh man, Snapchat is reporting really bad guidance. But things have gotten so much worse in the last month that Snapchat now feels an obligation to come out and say, okay, that guidance was way too optimistic. And Snap's fate has freaked out a lot of other players in the ad spend space. Alphabet, Google down 5% today. Meta did Meta bad, down about 8%. Pinterest, Pinterestingly bad, went down 22%. The Trade Desk, one of the biggest players in the advertisement space, down 18%. Now, considering that a lot of these stocks were already down a decent amount from all-time highs already before the big beatdown today, paints this picture that markets have factored in a lot of fear, but it hasn't factored in enough. And what's going on here specifically? Well, the ad business is collapsing. Managers right now are thinking, why the hell am I going to spend a ton of money to advertise to customers that are increasingly not willing to buy my products? And the few times they do, my profit margins are just so damn tight. The fact is, when you get into a recessionary period, the first telltale sign is when advertisers are like, you know what, we're going to cut our losses and start being more defensive. No more need to throw money at getting new customers that we don't believe are going to buy much of our products anyways. Last year, ad spending went through the roof. This year, people are like, okay, you know what, we better save that capital and play defense. No more offensive game. It's time that we play the survival game, not the thriving game. And I believe Snapchat is a pretty clear picture of the situation we are in currently with the broader market as well. What are the institutional players? What are the big people that make decisions on Wall Street thinking right now? If they look at the stock market, what are they asking? Well, they are asking at what point have stocks factored in not just the extreme hiking of interest rates on the horizon and the chances that that gets even more extreme if inflation doesn't get under control, but they're also wondering, have we factored in the threat of a recession? And the answer so far has been no. Sure, the market has been obviously very willing and able to acknowledge rate hikes, probably not to the extent that we're actually going to get them, but the bigger issue is the market has only started acknowledging the big threat of a recession. A few weeks ago, the idea of us heading into the big R word was still considered a contrarian view. I know on financial YouTube and in the retail space, everybody's been talking about a recession for months and months. But in terms of bank analysts, when Deutsche Bank came out like a month ago and said, oh, we think there's a high likelihood that we're heading into a recession, that was still a contrarian view. Today, it's not a contrarian view anymore. Everybody's switching over to that thesis. And so if you're looking at the market and you're like, has it factored in a recession? You have to say no, it's only factored in a massive multiple crunching. But it hasn't factored in what's going to happen if you actually get not just a slowdown, but a huge loss of value in the overall economy. And Snap is the latest example of a stock that doesn't just signal, but really screams the situation that we're heading into. When advertisers see their sales slumping and they decide not to increase ad spend to try to get more and more sales, but instead cut back on it, which presumably would make their sales even worse, you know that what they're saying is that this economy ain't worth advertising into. This economy ain't worth it, Sally. And when businesses and people start giving up on the economy and stop investing in it, you know you're heading into a very rough time. And it's certainly been domino after domino in this market. Last week we had retailers like Target and Walmart report that they're seeing lower demand. We saw manufacturers struggling. Weeks before that, we saw growth stock after growth stock miss on their earnings. We saw some of the biggest companies and even big tech like Amazon start reporting bad numbers. And we're starting to really see how these companies are responding to this rough economic condition. And how are they responding? Well, by cutting advertising spend. Everything in this dumpster fire is really going full circle. And you go over to the S&P 500, 400, and 600 PE ratios on a forward basis, and I think a lot of people are looking at this chart and misinterpreting it. There's a few positives and a lot of negatives if you look into this. What are forward PEs? Well, they're the price divided by the 52-week forward consensus expected operating earnings per share, aka how much you're paying for future expected earnings, which means you have two variables here, the price of the stock and the future expected earnings. If future expected earnings are going down while the price of the stock stays the same, then PE ratios go up. If the price of the stock goes down while the forward expected earnings stay the same, then the PE ratio goes down. But if the price of the stock goes down but the forward future earnings goes down faster, well, the PE ratio still goes up. And we haven't seen that happen yet, but we're certainly at threat of that happening. But you focus on what we see right now, and you have the S&P 500 dropping dramatically in terms of forward PE, but really just starting to meaningfully join the mid and smalls, which tanked all last year. The S&P 500 forward PE ratio is below the 5-year average now, but it is still looking frothy if you look at where it's been trading since that dot-com bust, well down here. So if all else were being considered equal, large caps would have to drop a lot more to really reset even to the levels that we were at during that 2018 tightening cycle. But what's freaky about this data is that forward earnings have barely even adjusted yet. So while stocks have been bludgeoned dramatically, earnings expectations haven't, which means that everything looks cheap when in reality, based on the economy that we're heading into, it's probably not too cheap. Most of the American companies that are down right now are going to be a very, very good value if you look at it in terms of the next 2, 3, 4, 5, or especially 10 years. But over the next 6 months to a year, I mean, a lot of these companies are going to see huge, huge drawdowns in terms of their actual growth, if they even manage to have any growth. As companies like Snapchat, Netflix, Target, you name it, adjust their earnings downward, what happens? Well, they look frothier in terms of a forward PE. If the stock doesn't go down as the estimates go down, you're basically paying the same for less earnings potential. So, I mean, if you're looking at these forward PEs, it's clear that we are in a very, very good deal territory if the economy was still growing at a rapid pace. Unfortunately, it's not. It's slowing down. We had the first contractionary quarter last quarter. But if we start seeing deeper signs of a recession, I'm thinking these large caps are very, very pricey. I think a lot of the most insane discounts in the large cap sector are in front of us, which is great if you're looking for deals. But at the same time, it's not something that you want to be hit over the head with and completely oblivious to. So unfortunately, if you're somebody who's like, you know what, I think we're at the end of the cycle, I think the data suggests that there's a lot more discounting that needs to be done in the entire market to actually factor in the recessionary numbers that we're going to be seeing, and to some extent also the interest rates that we're going to be seeing. Although I think very, very quickly the biggest problem for the market is going to be that recession. It's one thing if you're discounting multiples, it's another thing if the business behind the multiples is seeing contractions. Investors of the last 4 months were freaking out not on a recession, they were freaking out really on the whole idea that people are going to be paying less for earnings. They were paying less for revenue. But nowadays, people are thinking, okay, well, actually, these companies are going to have less revenue and less earnings in the first place. And I came across this video I made back in June of 2020 when I used to make thumbnails that made me look like a YouTube finance supervillain. But I basically dove into this question of, hey, wait a second. Why is the market going up so fast when you have the economy literally down like 50%? Huge restrictions everywhere, most people staying at home, people being paid not to work, so on and so forth. And I used this analogy of a mostly broken down and rickety car. It still drives, but it barely moves. I said that was basically the market and the economy of May and June of 2020. The Fed, through aggressive monetary policy, and Congress, through aggressive fiscal policy, basically added a ton of jet fuel to the engine and allowed it to go vroom vroom. And it drove like a damn Ferrari through 2021. But instead of allowing the car to slow down and get to a natural pace, one that could allow it to have some sustainable upgrades that keep it on the road for a long time, we basically added a lot more fuel to it, with new packages as late as March 2021 and beyond that continued adding more and more flames to the fire, in addition to, of course, monetary policy that wasn't cut back until this year. And so by adding more and more fuel to this rickety car that was already going really fast down the road, it's now still going very fast, but it's going fast downhill. And nobody knows how to stop it because it's an old rickety car that doesn't have any brakes. And now it's the Fed's job to stop this runaway car by any means necessary. And unlike in 2020, we're not in an economy economy that you can stimulate your way out of anymore. You can't stimulate your way out of an economic issue that was caused by overstimulation in the first place. Adding more rocket fuel to this car doesn't help anymore. It makes the issue a lot worse. Markets right now are having to face the fact that, hey, overstimulation is the issue here. And the only way to stop this runaway car that's going 100 plus miles per hour without brakes down a hill is essentially to allow it to crash and blow itself up so we can build a new car. In the past, some have thought that the Fed could lay out some spikes in the road so that we can stop the car with minimal damage, but increasingly it looks like the car is just going to have to crash. And the fact of the matter is, nobody can tell you exactly when that's going to crash, how much damage it's going to cause, and because of that uncertainty and the fear, the very real fear associated with that, a lot of people in the markets are running for the exit. So anyways, that is my thought process on where we are right now in terms of the current economic cycle. Anyways, that caps off today's video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, private chat, daily morning briefings, as well as our full price target list, I'll put a link to ZipTrader U below. If you're looking to get up to 5 free stocks with Moomoo and try out an excellent trading app, I'll put a link to them below. Have a good one, folks, and I'll see you in the next video.